Thank you so much, sir, for taking out time and helping us with your insights for today's session. We are really excited to have you over at Finacle Shah classes. I'll quickly share my screen, and Prateek, who's co-founder at Finacle Shah classes, will be coordinating on the question and answer front, and the students will be asking the questions. We have alumni as well from our academy who are attending the session.
Sure.
Thank you so much, sir. Prateek, you can take over.
Yeah. First of all, thank you so much, sir. I have been personally learning a lot since the time you started your thread on value picker of commodity and cyclical investing. They have been a great source of learning. Thank you so much for coming today.
Sure.
So we'll begin with our first question. So first question is from Yashika Narang. She's our alumni. Yashika, you can please explain your question to sir.
Yeah. Hi, sir. Good
Hello.
evening. I work with Multiply currently.
Okay.
And my first question is that you caught the bottom in telecom sector and it indeed is playing out well. And you mentioned in your past interviews that wealth is created in cyclicals only when the margins are low and you expect the turnaround to happen. But back then there were so many issues in the telecom companies which nobody actually thought would ever get solved. So I just wanted to understand that during such difficult situations, how do you actually convince yourself to invest in such sectors?
Yeah. So, yeah, I think telecom, I had first talked about it 2019, I think, is when we started looking at it. See, I've been watching that sector for a long time. I believe that telecom sector has a huge runway and long tailwind as far as growth is concerned, because of the digitization which is happening in India and across the world. So telecom is going to be a basic necessity, obviously. So that was always there in the mind. Prior to all these things, like prior to 2019, few years before that, there were 13 players in telecom. So by 2019, they had come down to just 3 players. So I have traveled a lot also across the world, and I've seen even small countries have at least 3, 4 players. And the large country like India, I was thinking that they will at least have 3 players. So that was the time when I thought that now it is a situation where even the government will support the sector if required, and not let it become a monopoly or a duopoly. So that was the whole thesis behind this thing. You can't get the timing exactly right, but in this case, we did get it right because price rise started just a few months after we entered. And what we also do is generally we get a foot in the door first. So what my allocation is now would not have been the allocation when I start. So I will start with a small allocation, obviously. And then, as we start tracking the sector far more rigorously and closely. So things started moving in the direction we had thought. So we kept up ramping up our positions in that, and maybe a fairly large bet.
Okay, so understood.
Okay. So let me ask a second question from Pranisha side due to some urgent family emergency could not come right now. His basic question was, sir, he's also our analyst, he's working in investment banking right now. His first question was that whenever we are buying a sector which is broadly beaten down, and as a lot of retail investors and also our students who are not working, technically only into portfolio management, they don't get so much of time to research a particular company in depth. So is it advisable to just go with, top 3 or 1, 2 market leaders at the time of sectoral correction?
Yeah, I think that would be the way to go if you don't have too much time. There obviously the returns, if you get it right, also the returns will be far lesser than one when you have some outliers also in your basket. But if you don't have that much time to track, because the outliers can hurt you badly also. So you need to track them quite closely. So I would say that one should not invest in the outliers if one is not able to give enough time to the sector and to the stocks.
So like just as a follow-up question, like according to you, what would be a very big difference between our outlier and a market leader in terms of figuring that out?
Yeah, so the outlier would be, somebody who is not as efficient as the leader, that would be counted as the outlier. But I would still want companies which have survived past down cycles and so on. But there, the characteristic will be that, it is not as well run as the market leader. During down cycle, it will bleed a lot more than the market leader. Uh, but at the same time, when the cycle turns, obviously the alpha is much higher. And the re-rating also is much higher. So if you get it right, the outliers always give you far superior returns.
This the main reason, like in the outlier generating high alpha. So is it due to that factor that the change in PAT that will happen in the outliers will be much higher in terms of percentage EPS growth?
Absolutely, the change in PAT will be much higher. The change in the margin profile, the OPMs will be far higher. The change in the return on capital will be also far higher. So obviously the re-rating will be also higher. But at the same time, in a down cycle, all these factors will deteriorate faster than the leaders. So the downside will also be higher when the cycle goes in downturn.
Okay, all right, sir. Thank you so much, sir, for explaining it well. So, sir, like he has this very same question, broadly into that side. For example, we thought that a cycle will come up. We bought a beaten down stock, but due to some reason, the losses are actually increasing. That means the cycle is not performing as expected. So, sir, what are your broad benchmarks or your ideology where you decide to book your losses? It's not about the gain side, but rather on the losses side. How do you decide कि बस इतना loss बहुत है, मतलब we need to move forward?
But you generally have a sense that you go in with the premise that you might have to hold for, let's say, 2 years also without any returns or low returns or even some downtake in from what you have bought. But at the same time, you have to basically keep on evaluating. That's why I always say that starting position should not be you should not go all in. You should not put your neck through the door. First, put your foot in the door. And yes, sometimes it takes longer for the cycle to turn. Sometimes it is faster. That obviously variance will be there. So you have to be patient enough. And there will be times when there will be enough signals giving that if the worst is ending now. So basically you ramp up when when you're fairly sure that now the cycle will turn. So in that sense, you will minimize your losses. There could be examples where one sector which took me long time for it to play out was textiles, for example, which started last year, but it was in downturn for quite a few years, and I did get in quite early. So the thing what happened was that I was carrying those positions. So generally, I would only get into like 1% kind of positions initially. So obviously they don't hurt much, even if it takes longer. But if you get in with a very big position, then you will cut your losses. But with a 1% position or so, you will not cut your losses. You will want to stay put with that and ramp up when you see the turnaround. So that is exactly what happened with textiles for me. It took far longer for it to play, but I didn't increase my positions during all this time. And when I could see that things are changing, then that's when I brought it up to a reasonable position, and the sector has done well after that. Yeah.
All right. So just one question on this. So actually, I had two questions. One was your benchmark for getting foot in the door that you explained. That would be 1 or 2% of portfolio.
Yes.
But sir, you mentioned a very powerful line that there are some indicators that start signaling you that the cycle is for surely turning around. Sir, what are those signals that you practically track?
Yeah, so signals could be, basically, let's see, I'll give you some signals like what was happening with, let's say, the hotel sector last year, or rather the last 2 years. So in a bad cycle, obviously that was COVID induced, but still there was a bad cycle. You see that a lot of supply starts going out of the system. Those are, indicators that, now I think the time for it to turn around will not be very high, because what happens is when supply goes out and you are fairly sure that demand will be there. Uh, for example, in hotels, we were sure that once these COVID restrictions are lifted, the demand is there, and exactly that is what has happened. So what has happened for the hotel sector? We have talked about it quite a bit in a lot of interviews. We initiated it last year during the second wave. So we could see that a lot of supply is gone and demand is basically going to come once the COVID situation normalizes. So there was short-term headwinds, but long-term tailwinds which were evident. So that is what you should look for. That is when you get the best prices to enter also. So we loaded into hotels last year during the second wave, and it has worked beautifully.
Okay, so sir, if I just try to draw a parallel between the telecom cycle that you played and the hotel cycle that you played, both had these characteristics common, that the realizations, like in hotel, it can be average revenue per room, or in telecom, the ARPU, average revenue per user, both were almost on decadal lows, and supply was going out.
Yes,
Uh,
exactly. And the thing is that we bet on the best company in telecom. So because there were quite a bit of uncertainties there, so you should not bet on the company which can go bust also. So one is obviously a conglomerate. Everybody knows that. It's not a pure play telecom company. The second one is a pure play telecom company, and we consider that as a leader. And the third one was something which was really struggling, and if probably not bailed out, it would have gone down under, right? So we went with the leader in that segment because there was still a lot of uncertainty, and we believe that it will be this leader will survive even if things don't play out at the pace which we had anticipated, or if the government bailout was not there, but still we believe that this company would have survived. Uh, and that's why we went with that company. But in different sectors, it could be a different thinking.
okay. So, sir, like, I'm really sorry. I'm just getting, questions, sir, based on your answers. So, sir, again, two questions. One is like, uh, if like you mentioned, pure play telecom leader and the conglomerate, which was also entering telecom at a very, vast pace. So, like, if I take a broad perspective, the conglomerate had money coming from other segments too. They were cash generating. So, sir, didn't you think from that angle that the probability of survival, even if thing goes wrong, for that conglomerate would be much more easier than the pure play telecom player, and we should bet on that?
Yeah. See, I mean, just as a disclosure, I mean, I hold the conglomerate since I think 2005 in my
Okay.
personal portfolio.
Okay.
So, I mean, obviously, that was when I invested. It was not for the telecom play, obviously. Uh, so I have a very long-term holding in that. But when I played this cycle, I went with this. The primary reason was that so if the leader would have gone down, obviously the third player would have gone down, and it would have been a monopoly, which I was very sure that any sane government will not let that happen. So that was the whole thinking behind this thing, that it will never the telecom sector can never become monopoly. So that was the primary reason that I was expecting that, there will be intervention.
Okay. And so just last one final question, like where you mentioned that you track supply very closely during downturns, whether supply is going out or not. So sir, in telecom, because it is a government license approved business, it becomes much more easier to track supply. The telecom players getting wiped off from the market because SIM cards would be going out of the market. But on the hotel side, which is a very highly unorganized sector, sir, how did you come to this judgment that supply is going at a very heavy rate out of the market?
So that is again scuttlebutt, right? You see around and you know what is happening. You talk to different people. You talk over the years. You have developed so many contacts, and so you try to find out what is happening in the industry. So a lot of hotels were just not able to survive. And a lot of them actually, even if they survived, they were saying that we will not manage it ourselves. We will obviously let the efficient ones run this business on a management contract and all. So that's what we were talking to different people, different hotels and so on, the listed, the unlisted ones. And that's the sense we got. So our sense was that at least 20% quantity, 20% capacity has gone out of the system. And that can provide a lot of tailwind for the remaining 80%.
Okay. All right, sir. Sir, I thank you so much, sir, for so patiently answering every query. Sir, I think we'll move on to the third question. It's from Ahmed Mada. He is also one of our alumni. Ahmed, please continue.
Hi, sir. Ahmed here. Thank you for the opportunity. Yeah. Hope you are doing well.
Yes.
So my question was with regard to your mental model specific to the cement sector, right? So what we saw the last decade, 2013 to 18, 19, was the sector was consolidating at a huge pace. And then at the tail end of 17, 18, 19, you had a lot of acquisitions. So Ultratech acquired Century assets, they acquired JP assets, they acquired Binani Cement. Then Dalmia did a lot of small acquisitions. And then Birla Corp acquired Reliance Cement. So a lot of consolidation happened. And then 2021 were extremely good, right? Relative to what we saw in the last decade. Now 22 we come here, first, second half, we had a lot of cost pressures. And then what we recently saw was obviously Adani acquired ECC and Ambuja, subsequently to that, very sooner, Ultratech announced expansion. So what currently, as of now, what we say is there is cost pressure plus there is supply side that is again building up, right? And the small players have been beaten down well below their replacement cost as of now. So how do you perceive that sector to play out? How do you think about it?
Yeah, so two things. So first, let me get to your first comparison between 2017-18, the acquisitions then and what has happened now. During the first case, actually, there was a situation where a lot of these assets were either not in play, I mean, they were not operational, or they were operating at very low capacities. Ultratech being the largest and acquired the most, they did a price war, obviously, and because they wanted to bring the capacity utilization of all these acquired assets up. So that was a time when, in that sense, a lot of supply came in, because supply which was idle came into the market, and there was a pressure and all, right? Now, the situation currently is a bit different. What Adani has acquired is already running at a capacity utilization of 85%. Okay? So the first thing, a lot of people ask me about this. So I believe that there will be no price war, because one, the asset which has been bought is already at 85% capacity utilization. Second, it has been bought at a valuation of close to $200 per EV. So going in for a price war will not make any financial sense for the acquirer. Okay. Yes, they might acquire other things. Consolidation could happen. They might do expansions. All those things can happen. But basically, predatory pricing or a price war just doesn't make sense. I mean, I don't see that to happen. Regarding Ultratech, coming out with capacity expansion, I'm surprised, at why people are reacting so much. And this is just, getting too much into headlines, sort of. Ultratech always had plans of expansion, right? Maybe they upped it up by a few million tons, but if you read all the previous communication and all, you will see that they always had plans to, because now they are getting to a status where their debt is very low, and for the next leg of growth, they would have had to expand capacity. So in that sense, I think that there is too much of reaction to these news. I don't think they are too negative at all. Also, this expansion is required because your demand is growing at 9% and the supply is not growing equivalent to demand. So companies have to plan ahead and this thing. You don't want a situation where there is 100% or 90% capacity utilization. Cement doesn't get to that kind of situation. Generally, expansion would happen, when they cross 70% or something, because it takes time for the capex to come online. So I'm not too worried about that. I think there is far more reaction than what is warranted.
Got it, sir. But regarding the Ultratech thing, so they have currently close to 115 million tons of capacity. They already had planned up to 140. So that was already coming by 24. And what they did, what they announced recently is also coming in 23, 24, 25. So my point mainly was considering that it is not coming after 3 or 4 years. Those capacities will come in next 2, 3 years only. And as of today, we are anyway large players like Remco, Sri, or even Dalmia are operating below 60% inflation or thereabouts. So that will lead to even if not say pricing war, but you might not be able to increase your prices as much as your cost is increasing. So my question was pertaining to that.
Yes. So just you have to segregate cement into 5 different regions and 5 different, which have different dynamics. Now, for example, Ranco having less than 60% capacity, it's a south-based company. South-based companies all have far lower capacity utilization, right? Because there are too many players there. That market is overcrowded. Whereas in North, there are the companies we track are having more than 80% utilization. So region to region, it varies a lot. So it will be to make a blanket, assessment that this company, because Ranco cannot ship to North. It's not possible to transport this amount, these distances. That's why you have regional plays. So I think we should look at it regionally, where the capacities are coming, where the demand is coming from, and so on.
Got it, sir. So my next question will be, what do you think is the best region to play the cycle?
I think North Central are better regions for us. Of course, South provide a lot of huge undervaluation also. So if you are a bit patient, then and if you have a slightly longer view, I think you can take some exposure to South. But if you have a 2-3 year view, I think you should look at North and Central, or maybe even West.
Thank you, sir.
Thank you so much, sir, once again. So next question is from Kevin Shah, is currently one of our students from Cyclical program. Yeah, please, Kevin, continue. Yeah, Kevin, you can go ahead with your questions.
Hello, sir. First of all, thank you so much for connecting on the Sunday evening with us. So I am working currently for New Leaf Advisory Firm. So my question is, in one of the article authored by Aurum Capital, it was mentioned that the book profits and let someone else also earn. So can you kind of elaborate more on this, and how do you decide that peak range of valuation have reached?
Yeah.
And
so
yeah.
Okay. Hi, Kevin. Yeah, it's a good question. The thing is that what we say that, we are we want to say upfront that we don't know what is the top, right? We have a sense around it. That's why we say that you don't have to be exactly right. You have to get the direction right. If you're closely right enough, you're good enough, is what we say. And we have observed over the years that, the best prices on the stocks come before the best earnings of the stock. So we are a bit early in exiting because you just can't get the top all the time. We have certain criteria for exits and so on. It could be, replacement cost, or it could be price to book and so on. So different sectors will have different criteria for exits and all. So the thing is, people try to think of a holy grail of investing, that, I want to exit at the peak. We believe that is not necessary. You can set different ways for your exit strategy, right? You can look at it from price to book, or you can look from replacement cost, or you can look at your targeted returns. So different people have different strategies. We also have different strategies for different sectors and so on. And that's why we say that, that whenever we buy a stock, it will definitely go down. Whenever we sell a stock, it will definitely go up. We are quite honest about saying that, though I'm sure that it happens with a lot more people. So that's why we say, when you sell the stock, if it's going to go up, the person buying from you has a chance to make money. So we are leaving something on the table for the person acquiring.
Sir, so as a follow-up question, sir, what's the process through which you decide to trim or exit the business? So can you explain that while selling, you just consider demand supply scenarios and macro conditions, or there are other factors as well, which one should keep in mind?
So there, it could be a host of, there could be multiple parameters for you to look at. Demand supply is obviously the most important aspect you have to see when you do investing in cyclicals, right? But apart from that, you can have some other parameters also, like, for example, let's say you invest in a sector at, let's say, 0.4 price to book, and you have a strategy to exit at 1.2 to 1.4. And if you're able to do that, you still get 3x plus, right? Yes, sometimes it does go to twice price to book also, but that's about it. So you can still leave the 30%, the last 30%, you're fine. You still made 3x on your portfolio. So again, as I said, there would be, we also sometimes employ trailing stop loss methodology. So we would, let it ride, and from the high, we will put a reverse stop loss at 10%. It doesn't work always. What if it opens at 20% down, right? But most of the times in the larger stocks, it works like that. And sometimes you are shaken out of your position also, because it will go 10% down. Your reverse stop loss is done, and again it might go up higher, right? So that can happen, but there is no exact, science as to this is how it is to be done. As long as you made your targeted return, as long as you made good returns. And also one more thing we keep on evaluating is what is the risk reward at any point in time. So periodic checks on risk reward is what we do. And then we look at alternate opportunities also. So for example, let's say in sector A, this stock, for me, yes, I believe that can go still 30% higher. But if things turn bad, it can go 30% lower also. So for me, the risk reward in that scenario is 1:1. Let's say there is another sector, sector B, where I believe that the potential now for it to go up is, let's say, 60-70%, but my downside risk is 20%. So there for me, the risk reward ratio is 1:3, which is far more attractive than the sector A. And since we track so many sectors, we don't mind, leaving this and going to sector B. So we do a lot of this strategic thinking also in our research.
Thanks so much.
So just a follow-up question on Kevin's question, and especially on your answer part. Like you mentioned one scenario in that sector where you decide exit between 1.2 to 1.4 times price to book, correct? Sir, how do you come up with this benchmark for various sectors? Like you look at historical high-low valuation multiples, you come up with that ideology?
Yes, that's the primary source.
Okay, all right. Thank you so much for answering.
And that's why I say, cycles may not repeat, but they do rhyme. So it will not be 1.4 every time, right? Sometimes it will end at 1 or 1.2. Sometimes it will go up to 2. So that's why you have to sort of get the average and calibrate accordingly.
But so you just look at a hint for a range.
Yes, yes.
An approximate range regarding
yes,
high.
yes.
Okay. All right. Thank you so much, sir. That helps a lot. So next question, there are like two set of questions from Dhruv Doshi, is currently our Finbridge program student. Dhruv Doshi, please continue with your question.
Good evening, sir. It's a pleasure to have you here. So my first question is that structural growth companies have less risk compared to turnaround companies or cyclical companies. So what are the significant risks that you look for in turnarounds and contrarian investing companies?
Yeah. So let me do one thing. If I can, I would like to present something which will help in this thing. Can you give me access to present?
Yeah, sir. I've started multiple parties screen sharing.
It's enabled, sir.
Okay. No, I don't think so. Yeah. Okay. So before I answer this question, let me go through a few slides just on, because there will be questions in the future or there have been questions where some of these things have been covered. So I would like to, can you see my screen?
Yeah, yes.
Okay. So this is just the disclosure. I should have done it in the start, but anyway, we're not talking about any particular stock. So, but still the disclosure still hold, because the whole purpose of this presentation and this talk is basically education of investors. So that's the scope of this particular session, and so nothing should be construed as any advice. So the thing is, a lot of people will ask me questions on cyclicals and all that. So I always say that, the first step to successful investing is knowing self, knowing your temperament and mental fortitude, because every type of, investing requires a different mindset. Cyclical investing might not be right for everybody also. There will be, different people who have different, temperament. So for some, trading is suitable. For some, passive investing is suitable. For some, growth investing is suitable. For some, cyclical investing and value investing is suitable. So value investing and cyclical investing are actually quite intermingled. Most of the value investors are actually cyclical investors. Nobody wants to say it, but that's what it is. That's what I believe. So that's what I talked about, what there are different strategies, choose one which works for you. Some successful investor trade is, basically you have to remove bias and rigidity. So I've seen a lot of people say that I will not invest in cyclicals, and I say that you can't be investing in the market if you don't understand cycles. There are different types of cycles, which will be there in the next slide. I will talk about that. So you remove bias and rigidity, be open to different school of thought also. Also, when good times come, make it count, is what I always say. So don't get shaken out of your positions, which are, or devote the horse which is going to win the race. Ride your winners is what I say. If you have to cut, you have to cut the losers. And the best time to cut the loser is when the market opens next day. Many investors keep watching the index. We say, watch the stocks, watch the sectors, understand the businesses. Good stock at bad price may underperform bad stock at good price. So, and we are seeing this happening over the last 1.5 years. A lot of good stocks, and I will show some examples in the slides why a lot of good stocks are not performing. Just give me a second. Yeah. So investing is more of an art than science, is what I believe. You have to understand much more than financials to be a successful investor. A lot of it has to do with psychology, sociology, history is important. So temperament and behavior are the most important qualities. I think 80% trait or 80% of your returns depend on how you behave and how you get the inferences of the data. The data is available with all of us, right? What do you infer from that is what separates, a good investor from my average investor. So for cyclical investing, these are, like I said, these are the tools. Understanding the sector, understanding the business cycles, understanding market cycles. That also is very important. Loads of patience and overcoming of greed and fear. So fear will happen when you buy a stock, nothing happens for, let's say, 1 year, 2 years. In cyclical investing, the returns are never linear. For 2 years, it will do nothing, and in the third year, it will go up 4x. That happens so many times. So returns are never linear because you can't time the cycle exactly. That's it. So this I was talking about. There are 3 types of cycles: business cycles, market cycles, economic cycles. All stocks, every listed stock is affected by one or more of these cycles at any point in time. We'll talk about some examples. Okay. And there was, in the previous question, there was, talking about timing and all. So we don't have to be exactly right. We are good even if we are approximately right. As I said, don't have to get in at bottom nor get out at the top. Okay. My benchmark is, if I am able to buy even at 20% higher than the bottom and sell at 80% of the top, I'm more than happy. I think I'm super successful in that particular journey of that particular stock. Because our return expectations are quite high, to be honest. We will not enter a stock which doesn't have a potential to double in 3 years. That is our base criteria. And so, of course, a lot of times it goes far ahead of the potential, and sometimes it doesn't also, obviously. So you just have to get the general direction there. And we talked about, basically leaving something on the table during exits. And these are the exit strategies I talked about in the previous question. So try to get out before best earnings. Peak prices come before peak earnings. This is very important. Always understand that there is an extraordinary earnings in upcycle. Don't commit the folly of assuming these are normalized earnings and look at it saying that, oh, this stock is only 5p or this is only 7p. This 7p is not real, actually. The E has a limit of extraordinary earnings. So what you should always look for is normalized earnings. And that you can do when you look at long-term results of this company over the years. Then you try to find out what is the average OPM, okay, and that's how you basically come out with the average earnings, and that you see what valuation it is at based on those average earnings. So as I said, one can employ a strategy of getting it at some point, 0.2, 0.3, 0.4 of price to book and getting out at 1. So even if in this case, you still make 3x minimum. So this I've talked about. Never repent if price still goes up after you sell, as long as you have made good returns. This is very, very important. I mean, and we've had many examples. We still keep on having these kind of examples where we exit and the stock still goes up. But we had our stomach full with the returns, so we are quite happy. Even if it goes up, we don't mind. So don't look at PE. Price to book, replacement costs are better parameters. And these are some of the things which you should look at if the company has cash, manageable debt. Start initial, just putting the foot in the door. And as cycle starts turning, you add more and ramp up your position. Promoter buying, selling also could be a very good indicator, because especially with promoters who have had a long history. So that can give you a lot of idea also, how things are, whether the cycle is turning or not, or whether the cycle is turning from up cycle to bad cycle, and so on. No, it's not 100% parameter, because sometimes promoters can also be wrong, but I would say 70-80% of the time they are right. So let's get to the question. If you don't mind, can you repeat the question, please?
Yes, sir. What are the significant risks you look for in a turnaround companies and contrary investing companies?
Yeah, so the risk, as I talk about here, it should have manageable debt. Sometimes, I mean, we've had great returns in companies where the debt was so high that, maybe another 1 year of down cycle and the company would not have survived. But that company gave us the highest return. So again, that becomes a very high risk play. But generally, in our research, what we do and which we basically give to clients, we will definitely look at companies where that is manageable. If that is too high, if you get the cycle right, it will give you fantastic returns. But if the cycle continues down, then there is a chance of the investment becoming zero too. So so it depends on your risk taking capability. In a personal this thing, in the steel cycle, which actually started in 2015, me and Nitin both had invested in a steel company which was at a market cap of 200 crores and had a debt of 2,400 crores. Okay, it was an extremely high risk play that stopped over this cycle. So we had 2 entries and 2 exits in that. Gave us overall, first time it gave us at least 8x, and the second time it gave us another 8x. And that company is currently valued at, I think, 3,000 plus crores or 3,500 crores. So if you get it right, the payoffs are asymmetrical. I mean, it's unbelievable. But if you get it wrong, then because a company which has such a big debt, okay, even if the bad cycle would have lasted for another 1 year, we are sure that our investment would have become zero. There was a very high chance. So and when we advise to our clients, obviously, or when we give a research to our clients, we will definitely not give these kind of companies, because we have to also look at protection of capital. So for that, I give an example. This is a company which on an individual level you can invest into, but not we will never recommend this kind of companies to clients. So high debt is one of the things. Shady promoters or promoters who have not lived up to their expectations, or have again, when you look at the annual reports, it tells you about the promoters, what they're saying and what they're doing. So you look at the previous year's management commentary and you see what happens in the next year. You go back 1 more year, see what they had said and what they did. So if you go for 5 years, you will know what the management is saying and what they're doing. The management can be wrong for 1 year, 2 years, but they cannot be wrong for all 5 years, right? So that will also tell you about the management quality. And also, in the past cycle, how they have survived, how long the past cycle lasted, and what they were able to survive, and so on. Yes,
Thank
do
you,
we
sir.
have anything else?
Yes.
Sir, I have a few questions. Can I ask
Sure,
on this parameter? Okay.
sure.
So sir, like the first thing is when you said the highest risk is manageable debt. So sir, obviously you won't have some random benchmarks of debt by equity for manageable debt. Like how do you go about seeing management debt? Like even in the worst of the period, the kind of CFOs
Depending,
that will come.
depending on company to sector, ideally, uh, you know, the peak EBITDA to, that you can look at some
Okay.
of those parameters, or you can look at that to equity.
Okay.
Again, different industries will have different parameters.
Correct.
For me to quantify which one to look for at which industry. But I'm giving you some indicators.
Like broadly, it would be EBITDA by debt or debt by equity, broadly speaking.
Yes.
Okay. And sir, when you said that majorly in the down cycle, debt would be on a higher level. So sir, when you decide the entry points or in the stocks, sir, I think on a high debt company, EV by EBITDA, that majority people use in cyclical investing, I said that will give a very wrong indicator because EVs would be very high due to debt, whereas EBITDA won't capture effect of debt. And you advise that you obviously won't use PE. So apart from replacement cost, is any other thing, sir, that remains to look at?
So you can look at normalized EBITDA.
Okay.
Okay. And then come up with a picture.
All right. All right, sir. Sir, just one last question. I'm really sorry. I had written some. So, sir, you said that it's very important to differentiate between market cycle versus stock cycle versus economic cycle. So, sir, economic cycle I would keep away because actually no one can do that. Stock cycle, sir, you are already explaining to our students and us, sir. But broadly speaking about market cycle, sir, how do you take judgments on various sub-market cycle that goes on?
Very good question. So for that, let's go to the next slide. So this is, if you see, can you see? I
Yes,
put shots from screener, the PLN summaries, okay, profit and loss summaries for 3-4 companies, okay. The first three are typical, your growth companies, or which people will say are non-cyclical, right? Now see the first company, what I've looked at is, what has happened over 10 years. Let's say, compounded sales growth is 15%, profit growth is 14%, stock price CAGR is 18%, which is fairly okay. But out of that, what has happened in the last 5 years? See, if you see 10%, 8%, and the stock price CAGR is 22%. Okay. Now, at any point in time, what you can look at is what was the story 10 years back, okay, what it was and what it is now. So if your profit growth has been, okay, only 8%, let's say for the 5 years, okay, and your CAGR, stock CAGR is 22%, okay, then it tells you that this company is ripe for underperformance, okay, unless it has some tailwinds or something, unless it can grow higher than what it has grown, okay, which in this case looks like, that it is growing higher than the, but this is just 1 year, right? So we can't paint a picture. But again, the risk here is, that there could be a good period of underperformance, though their chance of, capital erosion here is far lesser, okay, but there could be some period of underperformance. Now look at the second case, okay. 13%, 8%, 13%, 17%. Again, stock price CAGR is much higher than the sales growth, and obviously you can see that there has been expansion of margins. Now the situation is that I think margins, we are in a situation where margins will not grow. In fact, they can degrow. So this 8% growth, okay, and degrowth in margins will not support this 17% kind of CAGR for this stock also. So you will see that, and that's what is happening. See, last 1 year, good to see the last 1 year picture for all of these, right? These are all, these high quality stocks and so on. In this last 1 year, they've not done badly, right? But see what has happened with the price. And I believe that this can continue for some more time for these companies. This can continue for another 2, 3 years, 5 years, I don't know, where they will significantly underperform. And, this for the first line, the 10-year to get in sync. Eventually, stock prices should reflect, the CAGR on stock prices should reflect the profit growth on a bare minimum, right? That's what it should do. So whenever there is a situation where, this, now the third one is even more, this thing, 12, 12 and 21. See, there is a big difference in the stock price CAGR. So again, this tells me this particular stock is one of the favorites of people, and people with just 15-20% correction in this stock are ready to jump in. But I believe that this stock can underperform for far longer time now, just because unless, of course, it can do very heavy growth. Now, last 1 year growth for this company is not a true picture also, because this company is into consumables, and so this company had COVID impact. So last 1 year obviously is not the right picture to look at the growth. And if you see the profit, even with a 34% growth, profit has not grown because there is pressure on margins and so on. But this particular type of company, though it is fantastic company, there is no doubt about it. This company is primed for huge underperformance. And the last one is one company which is in a different sector, which you can say is a bit cyclical. But if you look at this company's results, you will not say that this is cyclical. So, and if you see this company, of course, it's not been listed for 10 years. It is slightly lesser than 10 years. That's why you see the thing. So that's why maybe you can look at the 5-year listing. This stock has hugely underperformed. And if this sector has tailwinds or something, there is a very good chance that this stock will outperform a lot. Okay, this is one company which is there in the infra sector. I presented it recently. You see, that's why I brought it. So these are what is known as market cycles. So even the best of the companies, okay, the non-cyclical companies are getting affected by market cycles. The second company here, okay, from a period of 2001 to 2011, despite having similar growth for those 10 years, they gave zero returns. Okay. Zero returns for 10 years. Huh?
The second company.
Yeah, the second company. And from 2011 to 2022, this gave 21. This company became 10x. Okay, with a similar growth. Maybe slight expansion in margins, but still not something which will warrant a 10x versus a 0x. Okay, so that obviously means that market cycles are at play. Even for the best of the stocks, stocks which have a long runway also, the typical growth stocks you call them, they will also have market cycles. So that's why I put this out so that I can explain, what market cycles are.
It was excellent way to actually understand with live examples. So, sir, to just summarize one, so the right way to detect market cycles are, along with the CAGR approaches that people generally present, we should simultaneously keep on looking at the YOY and Q-on-Q numbers. Because if after a long period of time, if price starts underperforming the financial growth rates, the cycle is turning on the downside.
Yes. So market cycle is affecting the growth. And see, again, a lot of these companies were valued at 70 times, 80 times with this kind of growth, right? So somewhere it has to stop. I think with what is happening in the world, with tightening and all that, with the restrictions on the easy flow of money, or or the taper tantrum and so on, with your basically that generating some return from negative interest to zero interest, earnings yield will come into focus. That's when all these insane P's will correct, is what my strong belief is.
So generally speaking, if the company is called as a growth or quality company, so at like 8% profit growth rate and a 40% ROE, they must be generating insane amount of free cash flow, because they hardly have to reinvest anything back into the business for growth. So sir, why does market doesn't value such companies on EV by free cash flow basis or such methods to actually rationalize the numbers here?
So here also I checked, specifically for the third company, I saw the cash flow. Okay, the net profit I took the net profit for 10 years, and I took the cash flow for 10 years. Okay, you know what it was? Exactly the same.
Okay.
Okay, so then can you give 100 P to this company?
Absolutely.
That is my question. Okay,
Absolutely.
which the market is giving, right? So that's why I say that it is primed for underperformance.
Got it. Sir. Thank you so much, sir, for answering my question. Means a lot, sir. Thank you. Dhruv, you can continue with your second question.
Yes, sir. So you explained that replacement cost or price to book ratio can be one of the valuation methods. So are there any other valuation methods that you look for while while investing in turnarounds or other companies?
As I mentioned earlier, you can look at normalized earnings, and the history will tell you what. I think Skinner also has a feature, what PE trades and on. So you can normalize everything and plot your own graph.
Got it. Thank you so much, sir.
I am not able to see the Excel, guys. Are you able to see the Excel? Sir, are you seeing the Excel?
Sir, in view option, you can do
So
switch to
I
share
think
list.
Chintan Bakshi has a question.
Good evening, sir. I'm Chintan Bakshi. I work in ICICI Bank. So I wanted to ask that the most cycles which we see are normally in commodity businesses. So how do we analyze or see a cycle in a service-oriented industry?
So this is exactly what I've shown in this particular slide. I think I pre-answered with Pratik asking me these questions. I kind of pre-answered your question. So this particular, the first company is in the service segment. So there also you will see that you're affected by market cycles.
Thank you, sir.
I'm so sorry, Chintan. I just asked the question in a different manner. I had no intention of that.
Yeah, but I think the answer is same, obviously.
All right. Sailesh, as I'm unable to see Excel, can you please?
Yeah, of course. So, sir, the next question is from Preet. Preet is our Finnish program student. Preet, maybe you can begin with your question.
Good evening, sir. Pleasure to have you here. Sir, basically my question is, sir, after reading your tweet about sugar industry, you told that if we enter the cycle when it is going through a down cycle, we will make X returns. And if we enter the cycle in midway, we will make percentage returns. Sir, what if we enter a cycle when it is going through a down phase and it continues in a down phase for more years? Whether, and on the other end, if we enter the mid cycle, but we will make percentage returns, wouldn't that ensure margin of safety for us?
Yeah, so again, there are two ways to invest, right? One is contra-cyclical investing, and one is turnaround cyclicals. So contra-cyclical is when you are probably buying at peak pessimism. You don't try to buy on the way down. You try to buy when it is, the bottom of the sine wave. Okay. See, cycles will run in sine waves. So you try contra-cyclical investing. So it could be somewhere here or somewhere here, if you can see my figure. And it could be somewhere on the slope. I would rather have it here, So I would wait. And even for slight improvement, I see that is when you start improving. That's when the bottom has come and gone, right? So as I was talking about, there are two ways to invest. One is contra-cyclical, when you try to invest at the bottom of the sine wave. And the second is, when this sine wave is going up, you invest somewhere here when the turnaround is visible. Okay. So there are two different strategies to invest. Obviously, the price you will get at the bottom of the cycle or at peak pessimism, you will not get when you do the turnaround investing. So the thing is, what we do this thing in our personal this thing, I generally would invest in companies in peak pessimism, see those changes happening and see the turnaround happening, and after that we recommend to our clients, so that for them the weight is far lesser than what it is for us. So that's what we try to do.
Sir, my second question is that, sir, as in long run, sir, all business are cyclical, and to become a sectoral expert, it requires a broad time frame of 5 to 7 years of tracking a sector to be aware of a cycle upturn and downturn. And sir, can you please explain or state some indicators that that are your strongest area, so that we can start maintaining a track of track of those databases, and even we can start investing in that sector, and will help us in identifying upturn or downturn in that sectors.
Sure. So actually, I've done a lot of threads on Twitter also on different sectors. I've done on sugar, I've done on cement. But anyway, so I can talk about two sectors currently. One is cement. I talked a bit about it just in one of the previous questions. So cement is in a way a very different commodity. It is not it is a it is basically limited to what is happening in India, right? You don't have it is not affected by international prices or so on, because cement is very difficult to transport from one country to another. The cost of transportation and it being a bit perishable under different conditions, and primarily logistic cost of transportation is very high. So cement is a national play. And within the nation also, India being such a big country, you have 5 different regions. Okay. So what you have to see is, each region will have different characteristics. The north has, for example, has far fewer players. The central has fewer players. West also have, west is something which can be catered from north as well as from central in that sense. So there could be some overlaps, obviously, but then there is south and there is east. Okay. The south has the highest number of players, a lot of unorganized players, a lot of small players, and so on. So the dynamics, for example, in south and the north can be completely different. So you have to understand first the regionality of the company. Of course, there will be companies like Ultratech, which is across regions, obviously, and where that's why they get valued far higher, and their EBITDA per ton is always higher than the let's say, for example, a south-based player who is not as efficient as, let's say, Ramco or somebody. They can never have the EBITDA per ton which Ultratech can have, despite it being in all the regions and so on. So basically, first thing is region. Second thing, you have to look at what are the input costs for cement, right? Transportation is one big cost. Power is one big cost for them. Okay, whether they have limestone, their own mines or not. So these are the factors to track. So we will not touch any company which doesn't have their own limestone. Whether they have captive power plant, whether they have installed waste heat recovery systems, and so on. So all these things you have to track. Which company is doing what is the cost of power? What is the cost of transportation? Do they have railway siding? How do they transport their material to clients or distributors or dealers? So these are the input parameters you have to look at from the cost angle. And then obviously realization. What is the strength of the brand? For example, there will be certain brands who are able to sell at 10 rupees, 20 rupees, 30 rupees higher than the other local players. So you have to see the strength of the brand also while calculating revenue and so on. So this is there with cement. Okay, is international commodity in that sense that steel can be imported, steel can be exported, Obviously, government at different times will have different duties and so on. Recently, you know that government put export duty on steel, so the whole dynamics changes. So all these things you have to track. You have to track what are the iron ore prices, what is coking coal prices, which are the input, and so on. Also, steel, I would always say that you should always prefer integrated players who have their own mines. And for coal also, if they have their own mines and so on. So integrated players always have far better dynamics, and the profitability can be far higher for them. So these are a couple of examples, and things to track for different sectors.
Thank you, sir.
So the next question is from Shivani. Shivani is our Finnish program student. Shivani.
Very good evening, sir. It's a pleasure talking to you. And with valuing your time, I will directly come to my question. Sir, buying low and selling high is the common strategy which the market is using all around. But knowing the right time is the catch. So what if the low where we are invested remain low for a very extended period of the time? As you also said, sometimes take that cycle to take time to turn around, or it takes time for cycle to really come back at the peak. So, sir, what indicators we can use to lessen the chances of the occurring?
So, as I said, you should never try to take your full position when you start. Okay, one foot in the door is very important. Just as I said, 1%, 2% kind of entry you can make into a sector, and then you track far rigorously. Of course, as I said, you track demand and supply. So you can track supply. Let's say you see supply going out, but then you also have to see whether there is any demand destruction or not. If there is demand destruction, then supply going out is not going to help you for the cycle to turn around. But if there is supply going out and if demand is intact, okay, then that is when cycle turns. So these are the things you should track.
Yes,
so,
sir.
for example, with current steel, this thing, okay, there is not much supply coming in, but there could be a fear of demand destruction, right? With these high prices, and I think with the cool off in these prices, I think the sector has become far more better now, despite stock prices correcting and all. And that's why I always say, best prices come before the best results. We see the prices. I think Q3 were the best results, but the best prices came before that, much before that, for all the steel companies. So you have to calibrate according, because market is intelligent in that sense. They will always value ahead in time. And that's why I said, you can't wait for the best results to come out and think that, you can get out at the top. The top would have already come and gone. So, so one strategy could be, you see, you use reverse stop losses.
Yes, sir. Thank you so much, sir.
So just one question, sir, as like you have consistently explained across today's session that it's very important to judge peak profits or where extraordinary earnings will hit and exit before that. But sir, there is no, actually, as you said, investing is art. There is no scientific method to understand this might be the peak profits. So sir, what are like your framework to understand कि ये peak के around आ रहा है? Is it the EBITDAs reaching the peak of past cycle, or margins going historically very high as compared to last decade's average? How do you judge the peak?
Yes, I think past cycles will give you a lot of data points. But then you also have, see, let's say, I'll tell you one example. Let's say steel in the past, for example, gave, or rather, I've talked about steel already. Let me give another example. Polyfilms. For example, in the last cycles, in the previous cycles, you would have seen that, their margins, of course, there was one abnormal year in 2009 and 10 where some of them had 60% kind of margins, but that was for a short period. That was only for 6-9 months. So there you know that this is not sustainable. That is how my cyclical investing journey actually started.
Okay.
I've talked about this in previous interviews also. But again, so apart from that abnormality, you see that these companies will go to, let's say, 14% kind of margins, OPMs, and in the upcycle, and go to 6% kind of margins in the down cycle. At 6% OPMs, they actually start making some losses or barely break even. But at 14, they throw a lot of good cash. Okay. But the thing is that 14 is not sustainable in all the past cycles. But in this cycle, what has happened is these have gone to 20%. Okay. And they've still stayed there. So what has happened in this cycle? And that's where, that's why I say, you should keep on constantly revising and learning. The thing is, it should not only be this data point. You should also see what is are there any tailwinds? Now, what happened is during this cycle would not have lasted, I'm sure, very sure, unless COVID had not come. With COVID, they got another big tailwind because the need for packaging increased a lot with COVID. So it provided them a tailwind. And typically for polythene capacity to come, it takes at least 18 months to 24 months. 18 months to 24 months. Okay. So, so this tailwind helped them to keep that margin to, take that margin from, let's say, 16% kind of to 20%, and it has stayed there. Okay. Of course, I still believe that it is not sustainable. It will not stay there once things normalize and all that, because it is a commodity. But sometimes this kind of tailwinds also can come, and that's where you have to recalibrate and not be stuck that, okay, I will get out at 14, 15% margin and so on. If you get a tailwind, then you ride that tailwind.
Okay, so broadly, we can take a hint from the past peak margins, but if they come back again, we need to then analyze how long it might continue.
Yes.
All right, sir. Thank you so much, sir. That gives a decent framework. Thank you so much. Sir, next question I think we will take from Jayati Vyas. Jayati, she is our film student. Please, Bita, you can ask your question.
Good evening, sir. Hope you are having an amazing day.
Yes, yes.
Sir, my question is, Indian currency weakened against the US dollar, and weakened rupees does not go well for the domestic equity and the debt market, as foreign portfolio investors return from Indian asset reduces, promoting them to exit such investments or bets. And Indian being a heavy dependent on the importer of domination commodities such as crude oil, it presents the risk of imported premium. What should one ideology around this, where we sit on the cash, or we should pour more capital in it?
So again, macros will always have an effect, and I also believe that $120 crude is not good for our Indian economy for sure. If it lasts for a long time, it will have its effect. Okay, but at the same time, in my interview on 29th December to ET Now, I had mentioned that I was expecting this year to be tough. Okay, of course I did not have any premonition that there will be a Ukraine-Russia war, but I was fairly saying this based looking at the valuations with a lot of companies had. Okay, and the froth in the system. So the reasons presented themselves, and if this lasts for a long time, yes, there could be some, there could be significant effect. But at the same time, what if the war, stops tomorrow, and then immediately the things can change. The thing is, sitting in cash and waiting for the right time might work for some people, but doesn't work for everyone. For me, it is what has worked is, whenever I feel like as I said, I kind of felt that, this market is overrated. So I did not take too much money out of equity, but I went into there were many stocks, there were many sectors where valuations were very good. A lot of PSU stocks, a lot of other stocks which had sustainable 5% kind of plus dividend yields. So I had moved quite a bit of my portfolio to these bets from the ones where I felt that risk reward is not favorable. So that is what I do. Some people might want to sit in cash and wait, but again, it depends on person to person. For me, it doesn't make sense to be out of equity too much. And any drawdown, I'm willing to take it in my stride, as long as I have tennis balls in my portfolio, which I know will come back up. If you have eggs in your portfolio, yes, it makes sense to exit.
Thank you so much for your answer, sir.
So the next question will take from Kunal Bajaj. Kunal is our Simplest program student currently. Kunal, please go ahead with your question.
Good evening, sir. Thank you for your time. Sir, the first question that I had was, sir, you recently posted a screenshot of a company that you had invested in 18 years ago. And in your interview with Strategic Alpha, you mentioned that you still intend to hold on to that company. So in 2004, you would have referred to past financials of the company too. So what made you hold on to this stock for too long, other than the promoter of the company?
So again, so promoter is a go-getter, okay, is what I could enter. When I entered, it was very small company, valuations were quite cheap, and the company was growing. And over the years, I think this company just kept on growing. And see, for the first 10 years, it gave me just average returns, right? It never got re-rated. Despite it kept on growing. There was one sort of, diversification, which a lot of people believe that, that the company went ahead and they had some spare land and they just made a hotel there, because they said that we don't have any hotel in our town. So that was something which was not liked by many people. This cost was only 100 crores, which I kind of took it in my stride, and the management did say that, that is not their business. This is just one-off which they've done just because they had spare land in prime location. So, so that thing basically somehow I held on to despite that thing happening. And after a couple of years of that, the whole chemical sector got a lot more tailwinds. And though despite this company was growing, it never got the valuation. But when the sector comes in favor, that's when, stocks can get re-rated. And exactly that's what happened from 2014 to 17, 18. There was a tremendous run up in the stock. Okay. Post that also it has done well. For me, it has gone from a 600 bagger to again a 400 bagger and so on. But that's okay. It doesn't matter too much currently, as I believe that stock still has a lot of potential. The company is growing, so I will just hold on. So from the peak, it has corrected, I think 40%. But as I said, you cannot get out at the top, nor can you get it at the bottom. And this is the journey of an investor who basically makes multi-bagger returns. It is the journey which all the good investors have had. There will be significant drawdowns, but you just have to hold on. As long as you believe that this company is on the right track, there is no destruction, and the company is continuously basically adding capacity, doing capex, making it successful, and so on. So if it keeps on growing, you just hold on.
Thank you, sir. So the next question was on extraordinary earnings, but I guess that has been.
I think I'll give you an example. Yeah. So for you, I had put some example. Okay. So if you can see this.
Yes.
Yeah. So you see this, what has happened with this company, okay? This company, okay, let's say in March 2016 or something, had a earning per share of 1 rupee, okay? And the price then was 150 rupees, okay? And in just 3 years, it had an earning of around 785 rupees, okay? And the price was 4,500. But the PE, that's why I say never look at PE. This is an extreme example of that, obviously. But see, the PE was 150 at the price of 150, and it was only 5 at the price of 4,500. So what is a good point to invest in this company? What would you say? If you look at PE as a parameter, 4,500, right?
Yeah, definitely misleading, sir.
Yeah, so that's what happens, in cyclical companies, and when there is something which I called as whiplash upcycle, it's kind of unprecedented, and something is like a whiplash. It just kind of explodes. So see what has happened to this company, which was making at the best around 20%, 15-17% kind of margins, went to as high as 71% margin. You understand that these will never sustain. So this example I wanted to give you an extreme example, but you will find far more examples like this.
So I just had one more question. So with your preference in contrarian investing, you would have seen a lot of value traps too. So how do you spot them or avoid them? And as a follow-up question, what are the common mistakes that you have observed made by investors when it comes to cyclical investing, and any advice that you could give us how we could do it?
So value traps obviously can happen. It's possible that sometimes you don't get the return you intend. So for example, let's say, as I said, our premise is that, we look at whether the stock has potential to double in 3 years. Okay. But in 3 years, despite what we were envisaging to happen, despite that, if the stock doesn't run up, okay, then you take a relook, okay, and try to find out why it is happening. Sometimes it is there that, there will be some reasons why it is not getting valued. Either there is, it is in a sunset industry. For example, it could be, let's say, a company which is a auto ancillary, which is primarily dependent on ICE engines, for example. Okay, and the company has not, pivoted to being on the EV. So that company might become a value trap. So you have to understand the business, why it is becoming a value trap, and if you will find those reasons, then that is, you can exit that time, is what I would say. And sorry, second question.
Sir, it was on any advice that you could give, like the
Yes.
common mistakes that you've observed while cyclical investing, and how can we can avoid that?
Yeah, so I think two things. I mean, that is not too cyclical, but it is to any kind of investing. There's two things I always say that you should be guarded against is FOMO and loss aversion. FOMO is basically, if this stock we are talking about, the graphite electrode, which is there on the screen right now, I'll tell you, there was so much interest in this stock when it was touching that 4,000, 4,200, 4,500 mark and all. So many people asked me that, this company is available at only 5p. This looks like a 8,000 rupee stock, 10,000 rupee stock. So the thing is, the company which has gone out just 30x, okay, in just, I think, about a year and a half, right? How can you be sure of the earnings will last? The thing is that it is not having a monopoly, right? It is not in a situation where it is the only one. It's not Apple, right? That the earnings can sustain. There are so many other players. Competition will come. So these earnings, you have to understand that they are not going to be sustainable for a long period in time. And market is, quite intelligent. Much before the best results came, the best price had come and gone. Okay, and see what happened to that stock later, right? Everybody knows that. This is the old this thing. It went up to as low as 500 from 4,500. So the thing is, so a lot of this trend of getting into the stock at 3,500, 3,800, 4,000 is basically FOMO. These people would I can tell you, these people would have watched the stock at 1,000, 1,500, 2,000, 2,500, and so on, and then finally decide to jump in, and that is the top. So you should avoid FOMO, is what I would say. And second is loss aversion. Let's say in this particular case, okay, let's say even if you had got in at 4,200 or something, you should have a strategy to avoid that loss, because the down journey from 4,500 to 500 is very, very painful, right? So if you realize that I made a mistake, okay, you have to exit. You exit at 4,000, 3,500, 3,000, whatever. But then what happens with a lot of investors is they say, how can I sell at a loss? Okay. So loss aversion afflicts so many investors, especially, new investors I've seen. They just don't want to sell at a loss. But I think selling at a loss is one of the most important, characteristic of a good investor.
Thanks a lot, sir.
So the next question is from Dhruv Rathod. Dhruv Rathod is our Finnish program student. Dhruv?
Good evening, sir. It's pleasure having you and answer our questions. So, sir, in one of your interviews, you were speaking about averaging your positions. So, sir, if a company has been seeing massive growth, but recently due to the macros getting weaker, macros are not basically currently playing in their favor. So because of that reason, the stock price has fallen drastically. Then should one wait for the macros to get little better? Or if one has conviction that the business will perform once the macros get better, so buy it. What should our approach be at this point in this?
I would actually buy on bad news in this kind of situation, where I'm quite convinced of the midterm to long term prospect of this company. And this, I'll tell you what has happened in Q3, Q4. Lot of companies, okay, which we like structurally and where we have a fairly long term view, just because of these commodity price increases and crude price increases and so on, they gave excellent opportunity to add, because obviously margins would have eroded because of all this. The pass on, we all know that doesn't happen immediately. Sometimes it's a quarter or two, and so on. So I actually kind of really like these kind of situations where I have a long-term view on a company, and market provides opportunities to add at far lower valuations because of because of so many people reacting to quarterly news so much. One bad result, then they will sell at any price, and so on. And one good result, they will buy at any price. We tend to do opposite actually.
Thank you so much, sir, for that question. So, sir, my second question was based on one of your interviews. You said that understand the sector first, then the company. My question is, why is so it is important to analyze the sector, but if a company is not starting a business, it's starting a sector altogether. Also, what is so it's starting a new sector. So how to analyze an industry at that time?
Obviously, if you don't have other companies in the sector, then you analyze the company. That's a given, obviously. But even in, like, say, these new age companies and all that, there are quite a few companies which don't have any parallel, and there will be a lot of companies which have a parallel. They are getting listed, but the other companies are not getting listed. So you can look at those unlisted companies also. But yes, there are certain companies, I fully agree, which don't have a parallel, and then you have to analyze just that company.
Sure, sir. Thank you so much.
That the proportion of those kind of companies is far, far less.
Yes, sir. Got it.
So, just one question. I think Dhruv's main question was, which you missed out, was the first part. So, like, why do you believe that the sector characteristics should be studied first? Like, they hold more grip over a company's business performance?
No. So when I say sector, that's what you're trying to understand, the sector. Okay, what are the dynamics of the sector? Then you drill to the business. Obviously, the ideation happens with the stock, right? That
Right.
Okay, this stock comes on radar for whatever reason. Somebody tells that okay, due to why yes, stock get low. or it could come in some screen, or now we are tracking so many sectors for so much time. So a lot of times for us, it is that this ये sector में कुछ देखना चाहिए. Okay. So that, but a lot of times if somebody else is suggesting a stock or something, it will be a stock, right? So at least half of the times it will be the stock which is the first thing which is thrown at you, right? But if you have understanding of the sector, that will help you analyze the stock better, right? So that's why we say understand the sector first, because what are the sector dynamics? This particular stock might not have all the dynamics of the sector, or might not be affected by all the dynamics of the sector. There could be other companies which are doing these things much better. So if you understand the whole sector dynamics, then you will be able to compare other companies also better.
All right. All right. Thank you so much, sir. I got the answer. Dhruv, I think that completes your question.
Yes, sir. Thank you, sir.
Thank you. So next question, I think we'll take from Yash Gandhi. He is our Plus program student. Yash, but you can continue with your question.
Yes. Hi, Jiten sir. Thank you so much again for answering our questions and taking out the time. So my first question, basically, sir, a lot of investors that I have come across and they always say that time in the market is more important than timing the market. But you obviously have a more view that timing is also important in the market. And my question basically is more about the market cycle in a broad sense. So maybe in like 2008 financial crisis or 2001 tech bubble, were you able to judge that okay, things are getting very frothy, and did you had any factors where you could visualize that okay, maybe the bull market is ending?
So, so two or three major events. One is the 2000 tech crash, right? .com burst. So I was in the US just before that. Luckily, I don't know whether you know or not, but I had a software company there, and we had exited that company before the .com crash. So there, with kind of whatever, it could be luck also. We were able to exit our company at very good valuations to a Nasdaq-listed company in 98, 99. So that kind of played out well from my business perspective. Obviously, I mean, I was not investing too much that time, so it did not affect me. The stock market effect was not there, but from a business point of view, we got a good exit. Then came the 2008 crash. So there, I was sure by the end of 2007, I was very sure that there is just too much froth in the market. And despite all that, in fact, I had written an article that time in one of the Google groups and all, so that, that I'm really worried and so on. Despite saying all these things, I could still get on only into 1/3 cash. So 33% cash I could get into. 67% portfolio I was intact, obviously. This obviously also had this stock which I'm holding from 2004, some other stocks I'm holding from 2005, and so on. The portfolio which was left, so the 2/3 portfolio which I had left went down by 2/3. Okay, so everybody got affected. I also got affected in the sense, but then, as I always say, it's not a loss till you sell it, and it's not a profit till you book it. So the thing is that these corrections come. They sometimes last for long, sometimes they don't last for long. You stay in the market. If you have good stocks, they will come back up. Yeah.
Right. So actually, my question was, I mean, do you track any data points? Do you understand, like looking at or talking to people that okay, maybe the bull market might just
Yeah, so a lot of very street signals you will get. No, when your Panwala also start talking about stocks and all that, you have to be alert, right? And your driver starts giving you tips. That's the time to be alert. Simple basic
okay.
things you can come to know, and valuations. See, the thing is, you look at valuations of the companies which you're holding or which And there are a lot of other companies. Or if you know, as I call kachra starts flying. There are so many indicators you get from the street. And
Right. Okay.
if you're an investor for a long time, then you can catch those signals. It will tell. I mean, you will come to know that अब ठीक नहीं है यार. This is not. This has to correct. Who knows when, but this has to correct.
I see. Thank you, sir. And my second question was, so in one of your presentations, you had mentioned that over-analysis leads to paralysis. But, so in micro caps, we know that you don't have a lot of information all the time. And I mean, there are so many micro caps. So there's like paucity of time as well as information. But then how do you make sure that you make good decisions within those parameters?
Yeah. So see, micro caps will also this thing. I mean, I don't invest too much in micro caps now. Uh, Small caps we do, and a lot of small caps do have a lot of information. Okay. So this is our stock evaluation criteria. Uh, so you can just take a note of these things which we look at. Uh, Quite comprehensive. So, and I think there is enough information available.
Right.
Searching. So,
So sorry to interrupt. Are you sharing your screen? Because right now I can see Shailesh screen. If you want, okay, now I can see it. Okay.
Okay. Yeah. So this is a stock evaluation criteria. Okay. So we before anything comes out of a research, okay, we have a very stringent criteria. So at least 5 years of annual reports we will definitely be minimum 3 years of call transcripts if available. Not all companies have that. We prefer companies which have call transcripts or where we can understand the industry enough that we don't need call transcripts. Again, future potential. You said no, stocks should be bought on future potential. I mean, past gives you a sense, but money will be made if stocks perform in the future, or rather the company performs in the future. Promoter holding pledging, you can see. Management quality is quite important. And again, you might not have too many reports on that, but as I said, annual reports will give you a picture. If you join those pictures, it becomes a video. So let's say you join these 5 pictures, it will give you some sense of a small video, which will be enough for you to judge. Operating cash flow, debt levels, what is the competition. Then we do a lot of scuttlebutt actually. We speak with a lot of suppliers, dealers, customers, past and current employees, wherever we can get access to. And some other criteria like pricing power, whether there is entry barrier, what is the capacity utilization, what is scale and resilience of the company. I mean, is the industry large enough that this company can scale, and is the management bandwidth enough that this company can scale? Because nothing will happen without scale. See, ultimately, as a value investor, your goal is to sell your stocks to the institutions, to the momentum investors, to the traders. So for that, this stock should have sufficient. I mean, if not now, then in the future, it needs to scale so much that there will be sufficient liquidity, there will be sufficient interest by these players. And of course, most important thing is valuation. So it should not be obscenely valued. I mean, we are quite on a PEG scale of, PEG factor. We like companies at the most 1 to 1.2 is what we generally look at.
Okay. Thank you, sir. Thank you for the elaborate answer.
So the next question is from Komal. Unfortunately, she couldn't make it to the session. Let me ask on her behalf. She's our FinBridge program student. First question was CFO versus net profit minus CFO can be manipulated to by liquidating receivables, inventories, or increasing payables. Inventories and receivables cannot fall below zero, and creditors will not extend credit indefinitely unless payments are made within due. What checks can one do around this and connect the dots?
So again, history. I mean, you can do this for maybe 1 year, at the most 2 years. You can't do it consistently, right? So history will give you a picture.
Sorry, sir, I didn't get the last part.
So history will tell you about, it is manipulated or not. You can do this for 1 year, 2 years at the most, but beyond that, you cannot do it every year.
Got it. Got it. And so the second question was around retail investors, like they basically follow FIIs. Retail investors follow moves of FIIs, or we also track, top 100 shareholders who have basically made the list. As FIIs are generally known to be smart or long-term investors, or the one who basically understand the businesses properly well as compared to retail investors, then why have you cautioned us on this, like not to follow FIIs or top 100 investors?
No. See, I have never cautioned anybody. They should do what is good for them. The thing is, what I have cautioned against is, the irrational pricing. And I mean, I've been tweeting about all this for quite a while now, and luckily, finally, it is playing out that these stocks, these are obscenely valued. Yeah, I mean, I've never had a question on the quality of these companies, but it is a valuation which I always kept on, questioning. Again, see, you have to understand what is the risk appetite of the FII or foreign portfolio investor, and what are the return expectations. It could be completely different from what your return expectations are and what your risk is, right? FIIs could be happy with just 7-8% kind of returns also, because for them in their markets they get just 1 or 2%, and even after hedging and all that, if they can get alpha over that, and they are quite happy. But for us, those kind of returns will not even beat FD plus interest, FD plus taxation. So again, the criteria is completely different. The return expectations are different. The risk is different. They can sit on any position for 10 years without any performance, whereas a retail investor might not have that kind of outlook. So I don't think it should be followed too much because again, the mandate is different.
Thank you so much, sir, for answering her question. We had a couple of questions from our behalf. Pratik would take over from there. Pratik, maybe you'd like to answer the last bit of questions, which we typically do.
Sir, just last 3 questions, and sir, broadly, those are never on investing. It's based on your journey as an individual. Sir, first question that I always ask all esteemed people are like, sir, can you please share with us some of reading recommendations which have been very impactful, but they are not that famous in market, like some unheard but impactful reading recommendations on thinking process or how to build a business?
So again, I mean, I used to read a lot before, but now I don't get enough time to read. I'll be very honest with you.
Right.
But what has impacted me a lot is Ben Graham's work. I've read Security Analysis and Intelligent Investor, and those are kind of Bibles for me. Again, a lot of people like different reading and so on, but this has worked for me. Value investing has really worked for me in my life, and I just try to keep on honing that. And also, I've been reading Howard Marks also. He's also quite good.
Okay, so you mean
even Parag Bhai's book was very good, so that should also be there. I mean, if somebody wants something offbeat, I think Parag Bhai's book will be good.
Thank you so much, sir, for that. Sir, my second question would be like, sir, what mistakes, if any, sir, did you commit in the initial years of your career that you would like this young generation to definitely avoid?
Yeah, so again, basically, mistakes, I have made many. For example, before getting the sugar sector right, in the past cycle, I made mistake. I held on to those stocks for many years and so on. Basically, I invested at the peak. This thing. Luckily, now the positions were large enough for me that they could take me out of the market. All this is the cyclical investing framework, which I've been sharing with everybody, is something which is self-learned uh, from the mistakes I've made in the past. And also, some individual mistake I can talk about is, believing in some stories and without, it actually, maybe, there was a company called Aurum company, I don't know. This is one example I can give, which was actually basically a tea company, and they had an interest in an oil block with a foreign company who was the operating partner in that oil block and all. So I believed in that story, and that partnership ran into problems, and that is a company which I held on for many years, just looking at the story that oil and gas will deliver and so on. And eventually, promoters actually were not good, which I kind of realized too late, and I had to book loss in that. So that is one company where I think I can say that it was a big mistake. Obviously, there were smaller mistakes all around. As I said, I got into stocks at the wrong time and so on. But luckily, because of the investing process I have, our initial positions are quite low, which doesn't impact our portfolio. So that's the reason, we have kind of, basically refined the process in such a way that mistakes will not hurt us a lot.
Excellent, sir. So thank you so much for that answer. So last one final question from our team side. Sir, one crucial life-changing advice that you have ever got and that you would like to share with us.
So again, I think for me, it's been a journey of, basically, I don't have any mentors in the stock market, to be honest. I have a lot of friends, but there was whatever I have learned is through self-experience. Of course, there have been many friends who have had an impact on me. It will not be right to name just a few. I have a very good trust network, obviously. But one advice I will like to give investors is, never try to become, too rich too soon. I think that is, it can work. Sometimes it will work for one or two people out of 100. And those stories are what we hear. There are 98, untold stories which you will never hear, doing the same thing in a different stock and not being successful and being driven away from the market. This thing. So there are a lot of good investors who had very concentrated portfolios and have done excellently well. Okay, but those are outliers, is what I would say. There are hundreds of stories or even thousands of stories where someone doing something similar in a different stock or different set of stocks have lost all their money. So basically, I would say that create your own path. Do not blindly follow anyone. Be sufficiently diversified so that one bad decision should not take you out of the market.
Thank you so much, sir, for that. I was actually writing it down. Thank you so much, sir. Again,
yeah, it was nice talking to you guys. I mean, I'm really happy at the questions which you guys let me. Made me also think a lot, and so it was really good doing this session with you guys.
Thank you so much, sir, once again. And it was genuinely a pleasure to have you here. On behalf of everyone, faculties, students, as well as alumni, we learned a lot from this session, and we hope that you'll bless us once again in near future with similar key learnings as well, where we can discuss a more add-on to this discussion, of course. Thank you so much.
Thank you so much.
sir.
Have a nice one. Bye.
Bye, sir.